Samantha spoke to Sanlam Private Investments Director of Investments, Alwyn van der Merwe, earlier today on the investment company's stock selection for 2012. And she started off by asking about the performance of the group's performance over the past 12 months. I'm saying a brief goodbye with this interview. I'll be back at the top of the hour with hot stocks. See you then.
It's not necessarily that we pick the high ROE stocks, but the market generally pick the high ROE stocks. If you look back to 2011, it was a year that I would have classified where people said there was just lack of visibility. And as soon as people say there's lack of visibility, it means that they are uncertain. And then when you're uncertain, you can do three things. Firstly, you don't pay up for risk. Secondly, you reduce your equity exposure. And thirdly, within an equity portfolio, you make sure you have quality shares. And quality shares are shares that I would define as shares that give you a high return on equity. So what you found last year was that in this uncertain environment that the high quality shares outperformed the lower quality shares. So in our portfolios, we had a combination of both, because in some cases we just felt that some of the so-called lower quality shares got derated or just simply became too cheap, and we paid attention to the valuation, we included it in the portfolio. And then in other cases, some of the so-called high quality shares became too expensive. So one of the shares that we sold was Pick n Pay, which, if you go back in time, was a high ROE stock. And we just felt it was too expensive given the problems that the company had. And we sold it from the portfolio, where we tried to enhance the quality of the portfolio, of course, was by adding Capitec, which was arguably an expensive stock. But if you look at the margins of the company and the growth profile of the company, also the quality of the management, we certainly argued that's a high quality company, and we included it in the portfolio. Another one where I think you could argue about the quality company that we included was Old Mutual. But there it was simply a case of valuation. Mutual was compellingly cheap in our mind. If you look at the discount to embedded value that it traded in August, and we simply felt that the management need to make a few announcements in terms of what they're going to do with their assets. It happened almost a few weeks after we included the stock in the portfolio, and now the rest is history. Old Mutual share price just went from 12.50 to wherever it's trading 19.5 Rand today. So it had provided phenomenal performance to our clients.
Let's look at how the markets have performed for the first quarter of 2012. Just looking at the JSE All Shares performance, return of 6.7%, S&P 500, almost 10% so far return. Are the markets a little bit confused, or are they forward-looking?
Yes, it's interesting. I think what we've seen in the overseas markets in particular is that the markets are just simply playing catch-up. If you go back to 2011, equity markets came under severe pressure in the third quarter of last year, and I think equity markets actually overreacted to the negative news flow that we saw at the time. So the initial part of the recovery that we saw in the fourth quarter, to my mind, was simply a correction of an overreaction that we've seen in the third quarter. If you look at our own market, we only did 2.6% last year. And it's not that our companies didn't generate earnings. The operational performance of companies were good. I think if you look at the overall performance, the operational performance, earnings went up by 35%. It was really the rating of the market that came under pressure. And again, if you look at the performance of our market, it is really the low quality stocks in January and the first half of February where the so-called low quality stocks performed well, because those were the stocks that derated. So you would have seen that shares like Anglos and Billiton, they performed pretty well because commodity prices also responded. I think looking forward, the interesting thing is, how would you put an equity portfolio together? What is the kind of balance that you want to bring into your portfolio? And maybe we can discuss that.
Hedge fund managers globally are still sitting with a net negative equity exposure right now. How does that inform your asset allocation strategy? If you
go back to hedge fund managers globally, their equity position over the last 3 years, they really struggled to get it right. They were very reactive in their response. So when the news flow was negative, they reduced their equity exposure, and of course then at the point where the equity exposure was the lowest, the news flow changed positively, the markets risky assets went up, and they actually missed the performance. Now, if you look at the exposure in January, as you say, they actually had a net negative position to equities, which means that this run in equities that we see now, they're again missing for their clients. My guess is, the answer to your question is, what are they doing right now? They're buying equities. So many portfolio managers who look at tactical indicators would have argued that globally equity market should have pulled back from a tactical perspective. We had negative news flow. The market hasn't really responded to it. And my guess is that some of these hedge fund managers, and not only hedge fund managers, other managers who were underexposed to risky assets as a result of the negative news flow, suddenly they realize that they're underexposed and they're buying the market at this particular point in time.
So basically what you're saying is they missed the boat.
They missed the initial part of the boat. How sustainable this run is, it is very tough to judge in the shorter term.
So as it stands right now, we're 1 quarter into 2012. What is your optimal asset allocation strategy?
Asset allocation, depending on your benchmark, because of course asset allocation is a very personal thing when we deal with private client money, and of course it's also very specific when you deal with retirement fund money within pension funds or provident funds. So I'm going to refer to benchmarks now. In terms of our own positioning, we would like to advocate an overweight position to equities, but not an aggressive one. We still think that there are some macro potholes around, and maybe I must just mention them. You know, people will still talk about Europe, they will still talk about the Middle East, they will still talk about the election year in the US, where US authorities need to take tough economic decisions, and then, you know, concerns about the momentum of growth in China. So the news flow will still fluctuate and will have an impact on sentiment in the market. Nevertheless, we generally feel that overseas equities in particular still shows decent enough value to have an overweight position to that particular asset class. Bonds, you've got to be very careful, because I think if you look at government bonds in the States and of course in Germany, those yields are very, very low. So it doesn't really provide you with an attractive return. So within the bond market, our view is that you should look at corporate bonds where you're comfortable about the quality of the particular company. And then for property, which of course is the third asset class that we would look at, property, we have a kind of a neutral weighting, because again, if you look at quoted property in South Africa, the yields have come off a bit. They're not that attractive, and what we see with the distribution or the growth in distribution, it's now in single-digit territory. So it's not that, you know, in a rather tough economic environment, these property companies struggle to increase their distributions.
Let's look at the potential potholes that could threaten the markets right now. You've got rising tensions in the Middle East. In the United States, it's an election year, and of course you've had an improving macroeconomic environment, 227,000 jobs added in February. In China, you've got growth coming in at 7.5%. That is expected to be below trend. And then, of course, the EU is still working through its debt crisis. Which of these factors are most relevant to South Africa's markets?
From a sentiment perspective, you've got to look at the whole lot, because the whole lot will have an impact on sentiment. I think from a company profit perspective, to my mind, we need to look at China and we need to look at Europe. Europe is still our second largest trading partner, and China, of course, is the biggest. So particularly for commodity producers, if the growth rate slows significantly in China, it will have an impact on commodity prices. It will put downward pressure on commodity prices, and investors will start to worry about the rating of shares like Anglo American, Billiton, Impala, Kumba Iron Ore, Exxaro, the whole lot. So I think that for me, China for me is the one macro issue that we feel that we've got to have a pretty decent handle on.
Do you focus on sectors that are expected to outperform?
We are stock pickers, so when we construct a portfolio, we look at the individual stocks. When you look at the resources sector, though, commodity prices generally drive the earnings of companies like Billiton, Anglo's, well, in fact, all those companies. So you've got to have a pretty decent handle on where you think commodity prices can go to. And I've seldom found anybody who can have conviction in terms of the forecast. So the way we look at it, we simply say, if you look at the historic trend in commodity prices, are those prices high or low? And if you look at the current basket of commodity prices, They are certainly not low. They're about one standard deviation about their long-term mean. So it means that they are slightly on the expensive side. Then you've got to pull it through to the valuation of the shares. So if you look at Anglo American, it trades on a multiple of just over 8 times. So my view on that is on the cheap side. So if you look at the actual share, it tells me that investors have to some extent already filtered in or factored in a view that commodity prices can come down. So we have comfort in the valuation of the share, and that is why we've picked it in our portfolios, but we acknowledge the risk that if commodity prices come down, the share price are not necessarily going to perform very well in the short term. But longer term, the valuation provides us with comfort.
Of course, one of the hotly debated topics right now is when we're going to see a turnaround in the construction space. Many are debating that there's still a while until we'll see an upturn taking place. What are your views on that? And do you have any exposure to construction stocks right now?
There's no doubt in my mind that if you look at the sector, that one must be very careful not to be overly optimistic in terms of the operational recovery. But again, we've got to distinguish between the share price and the operational realities of the world. If you look at shares like Wilson Bailey Homes, which is the one share that we started to accumulate for our clients, price earnings multiple has come down. So in simple English, the share is not expensive, the share is on the cheaper side. But it doesn't give you a lot of comfort if you buy a share where the earnings base is high or the margins are high, and the next thing is you get pressure on the margins, because the valuation then actually gives you a false sense of security. But if you actually look at the latest set of results that was produced by Wilson Bailey Homes, you will see that the margins have already come off. I think the average margin is 5.5%, which is more or less in line, slightly lower than the long-term average. So we buy a share that is cheap and the margins are already under pressure.